All right, guys, we're here for episode 14 of Off the Sidelines Property Podcast. I've got my co-host here, Onus.
Hey guys, thank you very much for joining us again. And we have Mr. Tuan with us in the building from Duotax. He is a depreciation expert and a quantity surveyor. So we're going to pick his brains today and get insights into why people should be getting their depreciation reports. Tuan, I'll get you to introduce yourself a bit for us and just tell us firstly how you got started and a bit about your background.
Awesome. Thanks for having us on the show today, guys. And so my name's Tuan Duong. I'm the director of Duotax Quantity Surveyors. We're experts in depreciation. We also offer the service of property valuation more of recently. But definitely our journey started as 7 years ago. And prior to that, I was a property investor. I was not a property expert by any means, but I did have some background in wanting to become a professional in some capacity. So when I bought my first investment property, of course, naturally you would do your tax return and they would inquire, ask you questions of, have you claimed depreciation? Have you claimed, water expenses, outgoings and such. And so I was interested in of course I'd like to claim depreciation. And he referred us on to what is now one of our competitors to claim a depreciation schedule. And so when I went down that path, it was quite interesting. And I couldn't believe, the quantity surveyor that provided the depreciation schedule for us, for myself, is you'd be claiming I think it was my first year I claimed was $13,000 tax deduction.
Oh, wow.
Because it was a brand new duplex I bought out in Sydney's western suburbs.
Yep.
And that really opened my eyes, and I couldn't believe how much of a difference that made, because as a investor that was on, I think, probably about a $60,000 income at that point in time, probably a good 10 years ago now. And I thought, that's life-changing money for someone that age with an investment property for the first time. And I thought, you know what, more people need to know about this. And that's how I started. And I thought, you know what, I could really reach out and educate a lot more people about this. And that's been our passion for the last 7 years. And I've got a great team behind me that believe in the same vision. And we go out there and we reach out to not investors directly, but through great people like yourselves, accountants, mortgage brokers, other property professionals, property managers, and we're seemingly spreading our our word and our knowledge to those that that go into property and try to, I guess, free themselves from create financial freedom through property. Yeah. And it's one of those ways. Depreciation is a bit of a no-brainer.
Yeah, that's awesome. I like that, Tuan. And I want to get your thoughts on why depreciation is so ambiguous. Why is it so elusive to, I guess, the common investor? And I guess, what is depreciation from a blanket standpoint?
Yeah. More than happy to. And so depreciation is generally the wear and tear of a building, in this case, and the plant and equipment that exists inside the building.
Yep.
So there can be things like, general air conditioning assets, oven, range hoods, cooktops, anything generally that's motorized will be a fast depreciating asset. Mm-hmm. We can go into the jux of what those assets are like and how they class it with the ATO. Yep. But generally, anything that depreciates or endures wear and tear in the building will be a depreciable asset in the eyes of the ATO, and they can claim that depreciable value as a tax deduction over a period of time. So it's the wear and tear of an asset over a period of time, and that's claimable as a tax deduction, and that's how the ATO has defined it. And the reason why it's so mysterious and a bit ambiguous about as to how it works and who can claim it, and the existence of it. And I think it's not something the ATO promotes. Right. The ATO doesn't freely promote any tax deduction per se. They have legislation around it. Yep. It's really up to your tax agent, your accountant, your property buyers agents that advise on this, because they're the experts. And that's why I think a lot of people do miss out on and are misinformed about depreciation, because they're not getting the right advice. Because let's face it, not every quantity surveyor is the same. Not every buyer's agent is the same.
Correct.
Same it goes for accountants. Not every accountant has the same capacity or knowledge as the next guy, and that can always create a bit of issues and lack of knowledge. And passing knowledge is very important when it comes to the space of property, especially when you're trying to compound property and build a large property portfolio. You need to leverage on every available deduction that's out there, not to mention, the skill in refinancing and all those things that you need to take into consideration as well.
Yeah, awesome.
And do you think there's a particular type of property or age that you couldn't claim any depreciation on, or do you think that it's worth having a look at anything that's bought, or do you have any thought around that?
Yeah, and that's a good question, because I think that is probably the main issue, that myth there about, can I even claim any depreciation? The big question is, can I even claim any depreciation? It's secondhand. That's probably one of the biggest questions that I was asked to an accountant from their client. And I think that's the issue, the reason why I think a lot of accountants may miss this for a lot of taxpayers, is that because the accountant essentially is taking a guess or don't know, and they're not in the right place to advise either an accountant, because strictly, an accountant will provide advice on tax legislation, but the legislation does say that if you want to organise a tax depreciation schedule or claim depreciation on your building asset, you need to engage suitably qualified persons like a quantity surveyor or someone that can work out construction costs. For example, your builder gives you an invoice for the construction. You could use that as a piece of evidence to the ATO, and if you don't have that, in the most cases of a second-hand property, which might be old, you will then need to engage a quantity surveyor who can estimate the cost of construction with retrospective valuations on, say, get provisions of an index from a property that's built in 1990, and use that index and apply it to a square meter rate. And then we can say, okay, well, back then it would cost us $180 a square meter to build a property or something like that. And using those rates, we could then apply that to organise a depreciation schedule and forecast that cost for 40 years. And so the biggest question is that we most often get is, can I claim depreciation on a second-hand or an older property? Is that, yes, there are some limitations. Now, we have to then we delve a little bit deeper and then look at the two assets of depreciation. The two classes is plant and equipment, and which is generally your fast wear and tearing assets like
Washing machines.
Yeah. Anything that's motorized, correct. Door closers, the hydraulic door closers, they're plant equipment assets. Loose furniture, they're not motorized, but they are considered plant equipment because of the nature of them being able to move. Of course, you can move something. Usually, a tall boy will fall apart faster than a built-in wardrobe. So they class that. And so those assets there will be depreciable, but in secondhand properties, we can't claim those type of assets anymore. The legislation did change on the 9th of May 2017, but we'll go into that a little bit later if you wish. But capital works, that's probably going to be the key one, especially for your clientele that are buying existing properties. If they are still doing that, they will be able to claim capital works, which is essentially the definition of building depreciation. So anything that includes slab, frame, brickwork, plasterboard, joinery that's fixed to the building, your ceilings, your roofing, they're all capital work assets. And so they will depreciate at 2.5% in normal use properties. In manufacturing, they'll depreciate a little bit faster, but commercial...
What does that rate go to then?
That goes to 4% if you've got a commercial property.
Okay,
that's in manufacturing.
For sure.
And if you've got a commercial office or warehouse or a normal residential house, they're at 2.5%.
And are we still talking about the same time period?
Yes, that's right. So the cutoff date for capital works is 1987. So anything built from 17th of September 1987 will be able to claim depreciation on capital works at 2.5%. Okay, but we can't claim on plant and equipment if there's second-hand plant and equipment on a purchase. You have to purchase those goods from a retailer like the Good Guys to claim depreciation. And the reason why they came up with the 9th of May 2017 legislation for the plant and equipment depreciation limitations is because of pretty much the fact of someone could go pull a dishwasher from their house, stick it in their home, and say, you know what, here's a secondhand plant equipment. I'm going to claim that. And that's what it used to be like. You know, you could go into a property that was built in this property here would have been built in the 60s. You could go in here and, you know, you'd have an old air conditioning unit. You might have some old lighting, old curtains. You could go in here and still claim that piece of curtain, the old lights, consecutive amount of times through consecutive amount of owners and still claim a residual value. So even though that someone bought it, say, 50 years ago for $150, today, if you had purchased the property today, we could go in there and go, you know what, the replacement cost of that curtain would be $50, and we'd be able to claim the second-hand value on that. And because it's less than $300, we could write off $50 in the first year, which is great. But then I think the issue was that the limitation is only to residential owners. You can still do that for commercial property, but in residential, they limited it because of the problem of people over-claiming the second-hand assets. But needless to say, Capital Works hasn't been changed at all, and that is the 17th of September 1987 cutoff for construction completion.
So yeah, to summarise, the myth that people think because it's existing I can't claim it is you've just unpacked that, which is awesome. But for a lot of people that they're not sure what they can and cannot claim, is it easy just to get a quote, or what's the best way to go about it so they can do their due diligence as well?
We live in a very fortunate time, and RP data is a very powerful tool. Most of the time, I would say probably more than 95% of the time, we'd be able to pull out a construction date of the completion of that property. And so what it takes is for someone to give us a call and say, hey, I've got a property, can I claim depreciation? It costs them nothing to find out.
Wow.
And of course, you know, with the tools that we have in this day and age, and even when the construction dates are wrong, and we always, you know, like you're probably familiar with, RP data shows so much information regarding photographic evidence of not just the sale, but also rental. And you'd be able to tell from there what type of build it was to give a guidance on the estimation of depreciation for the first few years. And using that data, we might say, okay, you've got a building here. It looks borderline 1995. It's definitely going to be able to claim somewhere around that $1,500 to $2,000 per year annually. And as a tax deduction, if you're on the regular, you know, on a normal tax rate of say 30%, you'll be claiming somewhere about $700-800 a year.
Wow.
And so naturally, they do the math on that. If it works out for them, $700-800 from 1995, you get a 40-year depreciation schedule, last until 2035. You've got another 13 years to claim. If you purchase this today, you're going to be well ahead at $700 deduction refund per year as a guideline.
Yeah, it's 10K. Yeah,
not taking into consideration a lot of other things, but yes, as a guidance, and that should only be better for, you know, your high income earners as well.
And have you got any stories where like someone's been like, oh, depreciation's not going to work, it's not going to do anything, and then you've actually like blown their mind or anything like that?
Yeah. So I guess I think when we started this in 2015, it was a big shock to not just I think the industry, but to us, we were like, you know, we've been in the business for only a couple of years, and we've been so used to everybody who came to us to get a depreciation schedule, the minimum would be getting is $4,000 or $5,000 tax deductions in the first year because of not just the capital work, but I could round up all the plant equipment in the house, which in a brand new house would, you know, today cost maybe $30,000. I would be able to value those assets at maybe $10,000 for a property that was built in 1980. You know, which is not eligible anymore, but 1980s. And I'd say, you know, these residual assets were probably worth $10,000, a couple of split system air cons, you know, old curtains, old blinds, shower curtains, things like that. And then I'd round them up and I'd give them $4,000, $5,000 tax deduction in the first year alone. That was the norm. And then so come around like 180, you know, a couple of years later, and we've got this legislation change, and all of a sudden we've lost all that $3,000, and now we're quoting people $1,500, $2,000. So it's been a big shock to a lot of investors in that time period. But I think the biggest thing for us is the education piece, because depreciation hadn't changed at all in so long. Because of the legislation in 2017, it became a story, a topic of discussion. And so I think I felt that we were more necessary or more in demand to extract knowledge out of, because we had to know the legislation to apply it to our depreciation schedules. And so we were having that discussion and people became used to it. And I think over time, people got comfortable with the fact that, a $1,500 or $2,000 tax deduction for a property that was built 30 years ago is okay, because it becomes a cash flow tool. I think that's the biggest key driver for this topic, is that depreciation isn't, it's not a get rich quick thing. It's definitely a tool for professional property investors to get ahead, because every dollar counts. And that's what we try to educate people on. It's not like, hey, yes, we're not getting the $15,000 tax deduction on a brand new house, but if we're getting $2-3 grand from the ATO, that $700 refund is a good cash flow tool for a reinvestment, for whatever it is, or a holiday or whatever it is to help you get along. And I think it's really important to know that. And I think, to be honest, most of our clients who are buying those older type properties, they've become very comfortable with that, because they're very much around the idea of, we need to drive every dollar that we can.
I like that.
Especially when the dollars come from the ATO.
Absolutely.
And Tuan, how often should people be getting their depreciation reports updated?
Yeah, the depreciation schedule is a forecast report. It's something that it takes place over a 40-year period from the build date. That's what the ATO is allowed. But I always suggest to organise a tax depreciation as soon as they exchange. If they exchange and purchase and settle, that means they're either given keys to a property, and that's the best time to get into the property, because if they're going to do an inspection or initial inspection, I'd always suggest to get the report done up front, because then it minimizes the disturbances of getting tenants in before tenants come in, if that is the case. But anywhere between then, the settlement date, and your 30 June, the next time 30 June comes around, you get, obviously, the fee is tax deductible. The tax depreciation fee that we charge is fully tax deductible. And that means that, organising this side of the year always allows you to claim that fee as a tax deduction next year. So it's great for cash flow. And if you do miss it, at least do that tax depreciation, because most people organise a schedule only once the accountant gives them the advice. So that would usually be post 30 June. And when you get the advice post 30 June, I'd always suggest to do it then, because if you don't do the depreciation schedule, even say, for example, I buy my property I settle on the property on the 1st of June. I can only claim 1 month of depreciation up to the 30th of June. But if then they organize a depreciation schedule in July or August with their accountant, and they say, I'm only going to get a month's worth of depreciation. What's the point? What's $500? But the truth is, if you don't claim the depreciation for $500 and you leave the depreciation schedule to be organized the following year, so you get a full year plus the month, now what you're going to do is, he's already lodged a tax return, your accountant or she's already lodged a tax return. When you go amend the tax return and organize to apply that 1 month worth of deduction, because you've got the report now, you'll be paying an amendment fee to the accountant. So it's an unnecessary cost that's additional to what you're already paying. So that's why I always suggest to get it now, regardless of how little the depreciation is, because something it's delayed gratification, but there's a bit of a penalty to that.
For sure.
So I always suggest working around those times.
That makes sense. And you brought up earlier before, just regarding the legislation changes. Let's get a bit deeper there into the nooks and crannies and what has actually changed. So you mentioned, I think the year of significance is 2017.
Correct.
That's when things started changing. So if you can elaborate on that and just tell us what to look out for.
What to look for, definitely. So we've come out well away from 2017. It's been 5 years. So I think everyone that's listening, most people anyway, will fall under this category, is that if you're buying property today, any property that's residential, owned in an individual or a family trust, not a corporate entity, will be, under new legislation, unable to claim depreciation on second-hand plant equipment. So you've got a residential property in an individual capacity or a family trust, or you will not be able to claim, non-corporate entities, you will not be able to claim depreciation on second-hand plant equipment. Okay. If you buy these houses or residential properties in your company, in a corporate trust, you will be able to claim full depreciation.
Right. So
Okay.
there's
But
a
of
difference.
course, then there's CGT things to worry about because there's no exemptions on CGT for corporate entities.
Yep.
And that's something you want to discuss with your accountant.
For sure.
Then you've got exemptions around if the old ruling of claiming plant and equipment still is now exempt for warehousing, industrial, commercial. They are exempt from that legislation. So they continue to claim depreciation as per normal. So if you were buying a warehouse or whatever it might be, or an office, you could still, even in an individual name, you will still be able to claim second-hand plant equipment on that 50-year-old building as a depreciated asset, and I would value it as a whatever the replacement or the residual value of that asset is. I would value it in today's market and give you a depreciation schedule with those assets. So commercial spaces are getting a little bit, commercial properties are still getting a little bit more depreciation, but residential have been fall into that new legislation. On top of that, the other thing is capital works, as I mentioned to you, has always stayed the same. So there's been nil change to capital works, which is essentially your building assets of bricks and mortar. They will be under old legislation, which means 40 years of depreciation, 25 years for industrial manufacturing, and they don't change. And that means that bricks and mortar can be claimed ongoing. I think that really sums up the gist of the 2017 legislation. And it's also important to also know that the legislation is very critical, actually, is if you buy the property prior to 2017, 9th of May 2017, you hold the property as a rental property past that date, but you make it an owner-occupied property at some point after that date, right? So I've rented it out. Then I decide to live in it, right, today. Yeah. As soon as I rent it out again, it falls under new legislation. It is no longer grandfathered, is the word.
Interesting.
Right. So even though you purchased it prior to that date, you were grandfathered, but as soon as you switch it back to owner-occupied and use it as a principal place of residence, you automatically fall under new legislation. And what I've been seeing people caught up for a lot when it first rolled out the legislation, people were buying their properties, brand new houses, expecting $30,000, $40,000 worth of plant equipment, claimable over 40 years. They were living in it for the first 6 months, claiming first home owners grants, getting a CGT exemption for the 6-year rule.
Yep.
I want to go into that because I'm not an accountant.
Yeah, don't worry. We've got
Full disclaimer.
disclaimers in place. This is not financial advice, guys.
Training and quality purposes.
And so they came to us and we were advising on the depreciation, and they were like, why is the capital loss being added? Why is my plant and equipment not being added into my plant and equipment, and it was registered as a capital loss only? I said, well, that's the legislation now. Because you bought a brand new property, you're entitled to claim full depreciation, because brand new assets are treated different. They get to claim full depreciation, just like you were to buy an oven from a retailer, Good Guys or Harvey Norman. You claim that asset, right? Well, you buy a brand new building, part of a package on a home and land thing. You could claim full depreciation, but they decided to live in it first, get the grant, get CGT exemptions, then they go organise a depreciation schedule once they rent it out. Then they get hit with, how come there's no depreciation on plant equipment, only building? And so naturally their depreciation went from 15 grand in the first year down to somewhat like 8.
Oh, wow.
And so that was a big blow, and accountants were like in shock. So that was a bit of there was a bit of a stink around that, but we worked around that and people got used to it, and 5 years on it's really become part of the norm. But capital loss report, we should get into that, is that if you have a plant and equipment list, what you would have been able to claim would be listed as plant and equipment next to capital works, which is your building. Total depreciation would be the first, plus the second equals your full depreciation tax deduction claim. Now, what's happened is because the plant equipment is no longer claimable, they've moved that in. We've had to move that to a capital loss schedule. And what a capital loss schedule is essentially is this: if you have a property and you're renting it out, and while you're renting it out, you decide, oh, you know what? I want to get rid of the oven, range hood, cooktop. I want to scrap the kitchen. Okay, so I've got rid of all these assets. Now, just because I've scrapped it, I can't claim a tax deduction because they were never depreciable. So they have to be depreciable under Division 43 to claim a scrap value, which I can get into a little bit later as well. But because they've been scrapped and they weren't depreciable, what they can go to is a capital loss schedule. So then, for example, say these oven, range hood, cooktop are worth about $5,000. What they can actually do is, because it's a capital loss, they can offset that capital loss with a capital gain elsewhere.
Okay.
So if they decide to, in their individual name, own this property, and they also have a crypto or shares, if they make, if they make a gain of $5,000 in crypto or whatever it might be, in that same capacity, they can write it off with the capital loss, and it just offsets each other. But what happens on the sale of the property is they're going to have to pay it back because of that claim.
Yeah.
Right.
So really, there is nil effect, but all they're doing is delaying the loss,
Preventing the inevitable.
Yep. And so that's one of the things that you can do. And in terms of, I was mentioning about scrapping reports. That's something that we do prepare from time to time, and also capital improvement reports, which are. Is there enough time to go through?
Yeah, definitely.
Yeah,
Absolutely. Let's get
Scrapping
into
reports
it.
have been are essential because what was happening is if you've got a kitchen and people do these days. I mean, let's face it. Renovations are. And you do a bit of it yourself, as I'm very aware. And you've got, say, an oven. You've got a renovated property. Okay, a property that hasn't been renovated. It might be 30 years old, built in 1990, but someone comes along and they've lived in it for some time. They decide, you know what, let's move out of it and rent it out, and we'll do a bit of a spruik up, and we'll make it look a little bit better. Kitchen, bathroom. There's about 30 grand worth of work, which is great. 30 grand depreciation schedule just for the new kitchen, bathroom, maybe a bit of paint, this, that.
Yep.
Now, what we can do then is, because of the property initially being a 1990 built property, which means it's eligible for capital works deductions because it was built after 1987. We've got 1990, 40 years, 2030. There's about 7-8 years left on this kitchen and bathroom that was originally there, because the original value, say for example, might be worth $10,000, and we've claimed, over that time, we haven't claimed, we've depreciated up until we left the property, say $7,000, and there's a bit left to go, about $3,000 in the bathroom and kitchen. Now, because we decide to demolish the bathroom kitchen, that $3,000 is depreciable because it's eligible for depreciation when you rent it out. Right? So the $3,000 would have been maybe, $400, $500 a year to the remainder of the life of that property. Yep. Now, what we can actually do, because we've scrapped it, demolished it, we can claim a scrap value on it. So then, because of that $3,000 we've estimated, quantified, we then put that as a scrapping value for the client, and they claim an immediate deduction of $3,000 effective in the year that they rip it out. So what is the important takeaway from that is, if you're doing works, demolition, and you think there's no value, it's wise to check the build date of that kitchen or that house built, or that renovation or improvement that was done that you want to pull down and redo. You should be checking for the age of it before and see if there's any residual scrap value left.
Make sure it's after 87, yeah.
Correct, yeah. And if it's an improvement, so if you're buying a secondhand property and it's been improved or done some renovations, major or minor, improvements don't have the same 1987 cutoff. It's actually 27th of February 1992. So you've got a house that might be built in 1950s, and then there's like a improvement. They've done kitchen, bathroom, new paint, new stairs, whatever it might be, new driveway. Those items there aren't from 87. They have to be after 92 to claim.
Okay.
Okay. And the last one I was going to think about was capital improvement, which is something I think we're doing more common lately. And that's transferring of properties between owners. And if you've got, for example, And it's really essentially what it's supposed to do, or what it can do from an accountant's perspective, is reduce the CGT liable for a person, or the stamp duty. For example, if you've got a property that's built, okay, so you've got a property, the father decides to do major works to the property, and he spends $400,000 demolishing it, redoing the house. Transfers it to the kids, and then the kids would then have, once, if they were to rent it out or whatever, there would be maybe CGT on the property. Now, then they get whacked with, for example, the property was purchased for the father for $100,000. They put $400,000 in it, that's $500,000. Now the kids go sell it for $2 million many years later. Now, technically, it's meant to be a $1.9 million capital gain, because $100,000 up until $2 million is $1.9 million. Now, how are we going to quantify the $400,000 if the father built it with no evidence at all? Quantity surveyor. Come in, check the floor plans, check the architecturals, check the OC's permits at that point in time, request from council. Documentation would have been submitted, part of the DA. Review all that, measure it, work out the construction costs. If we can do an inspection, great, get in there and check it out. And we'll come up with a construction cost estimate of potentially around that $400,000 mark, and help that client save $400,000 on CGT.
Wow.
So some of these things can be a value adds, and we've only come across it not because we knew, or we know the legislation. It's because we work closely with accountants, and they're giving us feedback. Hey, this would be a great help for the accountant, if for the client, if we can help quantify and justify, verify what the construction cost base is.
So Tuan, just from what you've kind of provided there, it's massive loads of knowledge, right? So it's really not just a one-stop kind of solution. There's a solution for each scenario, and I guess the best rule of thumb is to really just ask someone, or shop around at least, or come and see you guys at Duotax, because you guys are definitely across it, and it's not necessarily just for investors as well. Even people that have got their PPR, they have done any form of capital works, and life happens, and families move on, things are getting transferred from their parents to children, and vice versa. So it's always wise during that whole transaction process to engage someone like yourself to see what can be done, because things are always changing. I mean, if someone's lived in a property for 20 odd years, there's a high chance that they have done work to that property.
That's right.
So that's awesome.
And it's that simple. In this day and age, where we have the luxury of not having to get a quantity surveyor out to the house to get a depreciation, and you can actually get you a guaranteed deduction. We guarantee deductions before we even give you a quote.
Okay. There you go.
So
that's
people
awesome.
know where they stand. They know what value they're getting, and everyone knows, what kind of return on investment there is on engaging a quantity surveyor. And having questions to us, we've got everything I talk about here. I share it on my YouTube channel, because
nice.
Because it's information everybody should be entitled to.
Definitely.
I am a quantity surveyor. It's a very niche thing that I do. I'm very specific about what I do, and that is work out construction costs for the purpose of depreciation. But I think that there's no need to stop there when we can educate so many more people once we've experienced it ourselves. And when not just my personal experience, but through my professional experience with an accountant, engaging with them and seeing what they're doing for their customers and their clients through various scenarios, then I can really create purposeful value in what I do, whether it's through my reports or through the camera. Why not? This is why we do it, and everybody can do it. It's just a matter of connecting with someone. But starting with an accountant, for me anyway, it worked really well. It's a great place to start, and if that person isn't giving you that response that you're looking for, and the engagement you're getting out of these videos, but there are great accountants out there, and I always highly recommend finding the right team, right? And you guys know, as buyers agents, like, having the right team is the most really powerful tool.
100%. Yeah. 100%.
Awesome.
And Tuan, I want to get your thoughts, because if you've got a one-liner, like, how would you describe depreciation because it's not necessarily free money.
Yeah.
If you sell an asset, your property, it forms some kind of component of CGT. So what's your kind of one line or advice there? So like you are bringing the cost down
Yep.
into the present, so to speak, but then in future, it's kind of like, okay, I'm going to have to pay for it later.
Yeah.
So what's your thoughts there?
I love it.
Yeah.
I love it. And it's good that you're upfront, and there's no need to even hide it. The fact is, we all know no such thing as free lunch.
Yeah. Nice. I like that.
It is no free lunch, and the ATO sees it as the same. But truthfully, the tax depreciation component part of the legislation is a cash flow tool.
Right.
It's not a cash back tool.
Yep.
It's a cash flow tool.
I like that.
And that means that you're claiming $10,000 as a tax deduction today,
Yep.
right? And you're getting the full effect of that tax deduction at that tax rate, right? Of 30% or 46% or whatever you're making. And then when you go and sell that property, what's essentially happening is your $500,000 build costs is now only $490,000. That's what's happening. Okay, so if you bought a property for $1 million,
Yep.
and it was house and land,
Yep.
and the house was worth $500,000, the building,
Yep.
you've claimed $10,000 tax deduction. Your house is now worth $490,000, and your overall house and land is not worth $1 million. It's worth $990,000.
Yep.
Agreed? So when we go and sell that house for $1 million, we actually we're not neutral. We're actually up $10,000 because we've depreciated $10,000. But when we go sell it for $1 million, the ATO says you owe us $10,000 in capital gains tax. You've made a $10,000 profit, so you have a $10,000 tax liability. Now, the ATO, if you hold the property for 12 months, I believe, confirm with accountants, but if you hold the property for more than 12 months, you're entitled to a 50% CGT, which most investors, and that's what defines an investor, someone who holds property for an extensive period, longer than 12 months, they're entitled to a CGT discount. And that's 50% for individuals and as individual and non-corporate trusts. So then your tax liability is only $5,000. So here you claimed 30% of 10,000, but when you pay it back, you only pay back at the tax rate of 5,000. So you've claimed 10,000, but you're not paying back 5,000.
Yeah.
So the cash flow tool is that you have to eventually pay some back, but because it's a cash flow tool, you got it up front.
Yep.
Because people don't sell properties for years later if you're a property investor. And that's the very essence of tax depreciation. Just like a tax deduction for interest and all that, you're claiming all that up front and you only pay back at the end, right? But the tax deduction on depreciation is very essential. That is only cash flow. Bring it up front and you're delaying the pain a little bit later, but only half of it. And so technically, you're always up.
There you go. Boom. That's what I wanted. I was looking for that.
There is.
And,
definitely. It's a no-brainer. And if
Yep.
it wasn't the case, I don't think people would do it because accountants would probably, and you guys would be advising against it because at the end of the day, it has to benefit people. And, cash flow is always king, as they say, because it allows you the freedom to do more now.
Yeah.
100%. And from our point of view, that's what we want for our clients. The more cash flow, the quicker they can either A, pay the property down, or B, the quicker they can save that to then buy another one or have another deposit. So from our perspective and our clients, it's brilliant.
Perfect.
So,
And
Good tip.
Twan, if someone isn't happy with their current depreciation report, maybe they did it online. What's your recommendation there?
Is
it wise to kind of get it updated, or do you just stick with that?
We do. Great point, Ernest, and that is that we do seldomly do depreciation schedules again because there was a period of time when people used to sell 5-year depreciation schedules. I don't know why, but someone would engage a quantity surveyor and they'd provide a 5-year or 10-year schedule, and on the 6th or 11th year, they'd have to go, what do I do now? The building's only, 5 years old. So we do schedules again. or if there's a report that they've got and the accountant isn't happy with it or satisfied with the result, they can get a second opinion. And it's not about handing us a report. They'll say, the client's at their 3rd or 4th year of depreciation, what can you claim in the 5th or 6th year?
Yep.
We'll come up with a figure for a couple of years and they go, that's a no-brainer already. What's the construction cost you've come up with? Perfect. Let's roll with that. And that we can come up with that as a baseline. And of course, once we come up with these baselines as a cost, as an estimate, they're very conservative, but we'll try to be as aggressive as we can to try to help the client. And obviously there's tiers and thresholds that we can work towards with the ATO that's acceptable. And, as long as we can back up that with data, whether we use Rawlinson's as a guide, which is a construction cost handbook, or a lot of our projects that we also do, because we've got another arm that does new developments, and that's really recent construction costs. We can use and leverage that and say, okay, well, this is what it costs to build something 3 years ago in that area or in that suburb or in that town. And then we can use that as our evidence to support any such cases where there's an audit or whatnot.
That's magnificent.
Yeah.
And you touched on another service that you do, which is valuations.
Yep.
We know what it is. Some people don't. So if you can just highlight, give us a nice overview there, and how you help clients with valuations.
Yeah.
And what made you kind of get into that additional service?
Yeah, for sure. Look, naturally, our clientele are property investors, and we would get frequently asked by accountants if you can prepare a schedule, and people are almost confused the difference between, can I get a property valuation or depreciation valuation? It was like all these word models, but the truth is they were coming from the same source. The accountants were providing the advice, and we don't do valuations for bank purposes. We try to stay away from that. Most of our work is all private work, which is CGT, so capital gains tax, and stamp duty. And essentially, for those that don't understand, when you have a property, when you own or occupy it and you switch it to investment, that becomes a CGT event. Because when you own or occupy, you live in it. There's no tax on that once you sell the property. Once you move out of it, and rent it out, you then are in a CGT event, which means that it would be calculated from the day that you vacate that property, that it becomes taxable. So what do we tax on is the question the ATO asks. And that's where the valuer or a valuation company like ours comes in handy, because we then value the property at time of vacating the premises. And so from that time to the sale of the property, that would be CGT liable, and they would work out your capital gain tax liability from that difference. So the purchase price, the sale price, to the valuation price, or the valuation, the value of at that time and point. And so then they would work out your taxes based on that with your discounts and whatnot. But that's why we come in handy there. But if you rent out the property and you live in the property, you'll also have a CGT event when you've initially rented it out. And once you live in it again, you need to get a valuation to determine what's the value at time of moving into it, because it stops being a CGT event. So the first period so it's the inverse of the first scenario. And stamp duty transfers is when my mum gives me a property. That's a CGT. That's a stamp duty event, right? The ATO will collect stamp duty, or ATO, was it Revenue New South Wales?
Revenue New South Wales.
One of them,
Another tax.
At least it's not as bad as America. We don't have to have federal, state, regional.
Oh,
and things.
Okay. I'm not well aware of that, but I know it's bad enough here. That's for sure.
Yeah.
Not to mention land tax. So
and
OSR.
Can that be deferred at all?
Deferred.
In terms of payment, like once you've kind of you've lived in a property as a PPR and then you've changed to an investment.
There isn't any tax at that point. It's only when you sell the property.
Right. Okay.
But it pays to get it done then, because otherwise you have to do it retrospectively.
Yeah.
Which is, if you hold it for 10 years, it's a bit of a process to do a retrospective valuation. But if you can do it at the present time, it always helps. because you know best the value of your property at the time of moving out. In 10 years' time, it's sort of like a grey area, and it's a battle between you and the valuer. No, my house is worth less than, or, you know, because obviously if you say it's less, it might be favourable, and sometimes it might be more, and it might be favourable depending on the situation. So I always suggest to do it at time, because then you know best what your value is worth, and it's a bit of a negotiate or discussion, should I say, with the valuer. You know, I've done this work, I've done that work, I think it's worth more. You know, things like that can be discussed at time of valuation.
For sure.
Yep.
Well, that's awesome. Like, we have a lot of people on the podcast, and a lot of things you already sort of like hear and know and things like that. But from my perspective, like, that opened my mind up to a lot of things. And I've been doing depreciation for years, and I didn't even know there was half of those things people claim and that sort of stuff. So that's really awesome, and I really got a lot out of it as well.
No, thanks, Daniel. I'm glad
Tuan, thank you very much.
Thanks,
that brings us to the end of this magnificent episode. A lot of nuggets here, golden nuggets. So thank you very much for joining us today.
Thanks for having
us. And the insights you've brought, that it's definitely going to help a lot of people on their journey. So appreciate your time, Tuan.
Thank you.
Thanks, Tuan. Really appreciate it. And just to confirm for our viewers, so it sounded like there was a lot to unpack there for people that don't understand depreciation. But if you're ever unsure, just speak to the guys at Duo Tax, and they'll be able to give you a quote and let you know what they can claim or cannot claim, and then go from there. Because at the end of the day, like, with the interest rates increasing, the cost of materials, all that sort of stuff, every single dollar counts. If you're not doing little things like depreciation, other things to get that money back, or the cash flow now to then reinvest while the market's hot, then you're not probably speaking to the right people.
Yeah, that's right. And they're going to be in for a treat. The people that are buying brand new properties today, they're going to be claiming some good depreciation, I assure you.
Oh, with the build prices, absolutely. Yeah.
There you go.
Thank you, guys.
Thanks heaps for that.